All right. Thank you very much for joining us. Welcome to your webinar today on Market and Portfolio Insights with Western Asset Management. My name is Jeff Thurecht. I'm a Director at AAN and Evalesco, and I'll be your host for today. I'm very excited to be joined by Anthony Kirkham from Western Asset Management. Thanks for joining us, Anthony.
Yeah, pleasure to be here, Jeff. Thanks for having me.
No worries. So a little bit about Anthony. Anthony's Head of Asia Pacific Investment Management for Western Asset. He has more than 34 years' experience in fixed income and has served as the head of the Australian investment team, head of operations and portfolio management since 2007. So a raft of experience and been through some interesting market times over that time.
Indeed. And we'll certainly keep having them.
Yeah, that's right. So just before we get into the conversation, just like to let you at home know that today you're on mute and your video is turned off, so we can't see or hear you, but we do encourage you to ask questions. So to do that, you can click on the Q&A tab at the bottom of your screen and type in some questions, and we'll get to those either as we go through or at the end of the session. Also need to tell you that most of the concepts we'll be talking about today are about general investment market concepts with some specific examples perhaps. So I'm going to give you a general advice disclaimer and remind you that all we're discussing today is general advice only. Even though most people who are on the call are clients of Evalesco or AAN, we're not considering your personal situation today. If you would like to talk more about how it might relate to you, please get in touch with your advisor or with me after the session. So without further ado, today's format, we're going to have a bit of a Q&A. So as I said, encourage questions from home, but I'll start off with a few questions and we can get into it.
Sure, sounds good.
So as you touched on, we can continue to have interesting times and interesting markets. Maybe just start off with your thoughts on the current landscape and where things are at, and particularly some interesting things over the last couple of weeks.
Yeah, I mean, I think it's been interesting too because markets generally have this concept that, we're going to have this soft landing. The central banks are going to ease monetary policy globally, obviously, after tightening to try and get rid of inflation and slow things down. And they've generally got that across most regions. And you've seen that in terms of activity data coming down and obviously then inflation playing out the way they wanted it to. And we've seen already a number of central banks starting to ease. So, that process has worked relatively smoothly. And obviously seen, the ECB move, Bank of England moved, obviously seen Bank of Canada move a couple of times. A key one, of course, is really waiting for the Fed to do something as well. And it's now, because of the way data has sort of fallen in the US, it starts to look like that they will go in September. Markets, as we said, pretty active at the moment, and we're seeing some pretty big volatility in the last week. And you have seen, clearly people's perceptions around the US economy go from this nice Goldilocks type soft landing to something a little more testing in terms of the talk of a recession, and markets then clearly jumping ahead with that and seeing a bit of volatility in risk markets, and as a result expect maybe a bit more from the Fed. Probably a bit overdone at this point because it's one payrolls number. The rest of the data is been relatively well behaved when you look at some of that PMI activity data. So it's probably getting ahead of yourself in terms of the concerns there. But look, that is a risk that central banks did tighten pretty aggressively, and the play out from that can be, there's a possibility of being something a little more dire. But at the same time, you need to sort of, keep a balance on things and not sort of throw the baby out with the bathwater. And really look at that data and determine where it's going. But it's definitely softening up. As I said, that's what central banks wanted, to get inflation down, and I think generally it's moving in the right direction in a fairly orderly manner at this point in time.
Okay.
Yeah.
And so when you talk about the soft landing, what does that mean as opposed to more dire consequences that you sort of flagged?
Yeah, look, I think that, the whole game with the idea of a soft landing is that, central banks, manage this reasonably well and obviously recognise the signs that, policy has been too tight, they start to ease and you get activity coming back. This doesn't often happen, even though, as I said, I think markets have priced to perfection somewhat the idea that was going to occur. And I think there are still certainly some risks there that, it won't work as smoothly. And I think a good example of that is probably at the moment for us is clearly what's going on in New Zealand. Central bank there was clearly much more aggressive, got cash rates up, and have held them there for a reasonable amount of time. And the economy is really, feeling very weak. But of course, each of these economies are dealing with other structural issues. In their case, obviously being a smaller economy, been challenged by wages growth and therefore have had to, keep policy at a little bit higher. In Australia, I think we're going to have a similar type example where, clearly, inflation has stayed stickier than what the RBA was hoping for, and markets, started pricing in the idea of cuts, late last year, and of course we got further tightening. So, you can see how, there's been some challenges around getting inflation down because of those structural headwinds that, different economies have, and certainly in Australia we've got one.
Yeah. So we talked a lot of that is about interest rates and central banks setting of interest rates.
Yeah.
I know that's a big talking point in Australia and commonly, and been a big talking point. Is that typical across global markets, that's really the sort of key lever they have to pull to manage this soft landing, hard landing?
Yeah.
Are other economies a little bit different to us? Are we more reliant on that or less reliant on that than others?
Look, I think everyone, it's sort of the only tool that central banks have, and so therefore interest rates are that accelerator or decelerator if you want, and that's the only tool they have. Clearly, governments have that fiscal tool, which they need to work in somewhat unison. And I think that's an interesting part of the US market where the Fed was doing its work. It tightened, I would say reasonably aggressively, got cash rate, Fed funds rate up to 5.5. But and everyone thought, oh, okay, well, we'll start to see some slowing, and the US economy has obviously continued to power on a reasonable pace over the last 18 months, 2 years, despite having that tight monetary policy. But what was sort of missed was that, in fact, fiscal was relatively loose, in that there was still a lot of handouts going on. And, it's always hard to actually, calibrate that or determine, how much of an impact that's going to have on in terms of the economy. And clearly it had a greater impact than most were expecting, because, of course, if you looked at the yield curve in the US, it's been priced for a cut for a long period of time. That 2-year bond has been much lower than the Fed funds rate. And so, the market was sort of on the side of expecting things to slow up quicker than it actually ultimately did. And as I said, the fiscal policy was actually looser than what people realised. And of course, policy kept on that looser side with sort of handouts to, cancelling people's, loans on the university front, college loans. Also, there was sort of a recreation of the tech market in the US. So all that was sort of, pushing activity forward, which is not what, the Fed really wanted in terms of its desire to get inflation down and activity lower. So, bit of a challenge there. So, look, they're the two major tools, and if they don't get out of the way, then it's hard for the cash rate to do its job. Yeah.
Okay. So just a couple other sort of questions on recent sort of stuff. So you mentioned there was a lot of activity and volatility last week, kind of kicked off, and that was in relation to the jobs numbers coming out of the States. And then there was the Japan central bank increased rates for the first time in 100 years, or
feels like it. Yeah.
And so, so it's almost like there's a bit of a butterfly effect of, little things sort of flow out. So, how does that come about, and how much of that is real and how much of that is sentiment? And
there's actually quite a lot in that, for the reasons you just said. In that, if you think about the Bank of Japan, they've had super easy. They've been manipulating, markets, post GFC and almost prior. So, that's sort of a tool that we saw a lot of central banks, including ours, used during the pandemic, was really push cash rates super low, even offering, super cheap loans to banks to give people these fixed rate mortgages with super low. All that obviously designed to get the economy moving. In Japan, of course, they've had deflation for a long period of time. They've wanted inflation to come back, and so that's been their tool, and they've been playing that for decades now, and not really getting a lot of action. And of course, they had a target of having inflation at 2%. And I think we all laughed at that and thought, well, how could you possibly achieve that? But of course, in many ways, the pandemic's caused it because they're such a big importer of energy that suddenly that was a driver for costs to rise, the need for companies to actually increase wages for the first time in decades. And suddenly you actually have had inflation moving a little bit higher, which clearly is a bit of a challenge in an economy that's not used to that as well. And at the same time, you've had this period where you've had super high rates in other markets, including the US and even ours, and theirs obviously still being basically negative or zero, meant that Japan became a bit of a funding market for this carry trade globally, where you borrow and invest elsewhere. And suddenly in the last week, really, you've had sort of two things happen. One where you've had the Bank of Japan finally moving, as you highlighted, and really changing that game slightly by talking quite hawkishly about doing more. At the same time, you've had, the US, obviously, their growth sort of being questioned, and therefore the need for the Fed to do more on the cutting side, and that relationship's changed quickly. So there's been a lot of capital that's been forced to move, which is why it appeared so violently in markets over the past week. And it's sort of that, I would say, that easy carry trade has suddenly disappeared for the market, or at least been questioned, and meant there was a reasonable amount of unwind going on. So, I think that's a good thing, because Japan was in a real strife, right? Their currency was incredibly weak, and it was very hard to break that relationship. And suddenly these two factors have sort of done it in quick time now, and probably well over time. And so, it's a bit of a game change for the markets generally.
Mm-hmm. And what about, how does that impact Australia? I mean, have we been participating in that carry trade much here, or is that more a US sort of phenomenon? Or?
Yeah, I think, pretty marginally, just because, where our markets are and people's involvement, and the ease of getting in and out, it hasn't really been a major play for us. So we've probably been on the sidelines somewhat, but it is a bit of a game changer because, we've seen a big move in terms of Aussie yen, and that means that, those investors that used to come to Australia can now actually think about it, because they're not going to send money to Australia when their currency is super, super weak, but when it's got a sort of a more fairer value to it, then they might actually consider it, and you may actually see them, because they really have been quiet in our market for the last couple of years because of that relationship and where the currency's been. So, we may see something more, as I said, because that dynamic has just suddenly changed.
Okay, great. So I guess a natural lead on is then, what do you see as the risks in the market? How does that sort of play out? Is what we've seen, the start of something bigger, or is it just a natural sort of?
I think it's a natural function. I think, when markets sort of consider that, this is just, this is the way it's going to pan out, which I would say is the way markets have generally looked at the US, that, it is this, nice soft landing, Goldilocks type scenario. Equity markets seem to go up on, a negative and positive news, which is sort of, seemed quite bizarre. You sort of need a bit of a, questioning around that and take out some of that easy money, if you want, or thoughts of, how things were going to pan out. And so that's probably been good. I think sort of bringing it back to sort of those challenges, I think in Australia we do have a bit of a challenge, because you do want the central bank to be able to start easing monetary policy, because you can see that the economy is softening. And funnily, you get into a cab and the cab driver says to me, I believe that we probably are in a recession already here. And it's not surprising that they think that, because, basically he said he'd been sitting there for 2 hours, waiting for a ride. So it is definitely occurring here, where we're slow and you're sort of waiting for the RBA to do something. But at the moment, as I said before, we've got a bit of a structural issue, and some of it's been driven by housing. Our housing situation is challenging because you've got incredible immigration, certainly much greater than anyone expected over the last year. And I know the government's trying to address that now, but it's caused a reasonable amount of pressure on that housing side, and obviously demand for housing, which obviously just feeds into pricing more generally, and is obviously what the RBA is looking at. So you've got that demand side, and the supply side, unfortunately, has been, had its problems because a lot of those big, large builders that used to construct a lot of homes, really did go out of business, due to fixed rate contracts that, they couldn't meet. And therefore, they're just not there providing that supply. So, we need to do something on that demand supply relationship to allow, that change. And it's just not an easy trait because, as I said, that yes, you can close the gate a little bit in terms of immigration. They're trying to do that. But on the supply side, construction sort of challenged because they're finding it difficult to find skilled labour because, as we know, state governments are doing a lot of infrastructure, so there's a reasonable skilled labour being sucked in by that, and they do it at any price. It's not commercial, right? Basically, politicians want that stuff built in their term, so they're spending loads of money getting that done, and it's just really challenging, I think, for that building construction side to actually provide the houses that are required. So I'm just highlighting that dynamic only because that's sort of what is a bit of a handbrake, I guess, for the RBA to take action as soon as what people would probably like and provide a bit of a release valve. So the risk with that is that the delay in the RBA being able to do anything means clearly that the economy could slow a little further than you'd want. And then you have people sort of displaced from jobs and unemployment rising a little further. And that would be a catalyst, for clearly a bit more softness than we were expecting in this sort of Goldilocks soft landing type scenario. So that's sort of that's your out there risk. And clearly there's other risks globally as well, where geopolitically, there's a little bit of heat, which clearly then is disruptive for markets more generally and activity globally. So, that's obviously a bit of a out there as well. You never want to consider that in your portfolio, but it does mean that, there are some risks on the downside rather than sort of, I don't think there's too many nice surprises that we're seeing at the moment. Sadly, I think, we are in this state where, there is still going to be a little bit of pain.
Okay. With you mentioned the construction, issues around construction, some lenders collapsing. Has that had an impact on risk appetite for the lenders? And what does that mean for portfolios and how you look at those types of options?
Yeah, I think that's where you look at sort of, debt levels and credit growth more generally. And I think that is definitely been a little more constrained for that reason. I think, banks have definitely been cautious through this cycle. At the same time, you've seen a lot of new credit providers, step in and provide that or fill that gap if you want. So that's there. I would say, private credit's sort of doing that as well. And that's fine as long as everything stays, reasonably rosy. And I think that's, once again, something that needs to be considered within, portfolios, just in terms of, where the risk is and what type of risk that is and when will it be, somewhat challenged. And, that's definitely a part of the market, which has been good to fill some of that gap, but it's just whether it's been outsized and there's too much capital flowing into a space that's just doing loans just to get the money through without the sort of credit considerations that need to be made on that in that process. So that's also a risk that's there.
Yeah, I mean, we've certainly seen a massive proliferation of discussion around private credit, different new providers looking for it.
Yes,
and it's not something we don't have specific expertise in that area.
Yeah, no, that's right.
And so it's a difficult one to analyse. It's probably not right for a lot of portfolios. It's a little bit less liquid.
Yeah.
But what are your sort of general tips and traps for that sort of?
Yeah, I mean, it's like your general, tips for any sort of market that's expanding in that sort of speed is that you want to go with skilled managers, and you want to make sure that they're managers that have dealt through a cycle. And the unfortunate part about what you're highlighting is the fact that many of these haven't actually been in existence for a very long time. And in this type of lending, it's when things get into problem zone that you really need to have skilled management on the backside as well. It's all well and good to be able to do the analytical work to decide, this is actually a reasonable deal, and you hope that they've actually got that skill. But it's on the backside too, where you actually have to try and manage that out and work through it, that a lot of them probably are also somewhat a bit redundant and not tested. And that's that's really important to understand. And I think the other issue with that too is that, with this type of investment, it's not liquid. They don't, if it gets into a problem, who's going to get involved and who's going to bail out and how you're going to get your money back is the biggest issue here. And that's the bit that I don't think people totally understand, because we've had such an easy credit environment and certainly cheap cash environment. So cash has been flowing very, very, very quickly. It's how a lot of these investments have come about. We're not in that environment anymore. It's actually, costly and therefore more difficult to find that buyer. And that I think will challenge people, because we've had sort of decades of fairly easy cash. And suddenly, you're back to an environment that, we haven't, and a lot of investors haven't been in for some time.
Yeah. So certainly that's at the much higher end of the risk spectrum to what, you're looking at for the fund.
That's right.
Our portfolios.
Yeah, absolutely.
Given what you've just said, how are you finding opportunities or how are you managing that at the moment? Those dynamics.
I mean, I think, what we deal with clearly is a much higher grade. And, that's exactly why people were invested in our fund, is that they're expecting to have something that is defensive, that is there, for this risk-off environment that we're certainly in at the moment. And we're going to be in for a little bit of time, because, there's, as I said, the outlook is somewhat grey. And so therefore you want to have that defensive part of your portfolio. So, and that's when we set up the portfolio, that's exactly how we think. We want to make sure that it is going to be the ballast that people need during that risk off. And we've most definitely seen it over the last, any of these periods where we have had risk off, it's performed exactly the way you'd want it to. And why is that happening? Is because we do hold, high grade bonds. There's a lot of, government exposure in the portfolio, particularly in that sort of longer end, because that's, I guess, where you want it. You want the ballast that it behaves exactly how you'd expect during those times of risk off. And that's certainly what we're seeing, over the last week as an example, which is great. And that's key to the setup of the fund. At the same time, we can actually provide a reasonable yield, because, it is investment grade, and there's a nice spread still in that sector. And it is interesting when you look at our corporate sector relative to, say, US or Europe as major markets. Ours is generally a high quality market, and it's partly driven by the fact we don't have a high yield market. Mm-hmm. Those issuers go elsewhere to fund themselves. Our market is purely, really, at the end of the day, an investment grade market. So we have, the solid defensive credits in our market that are getting issued that we're happy to pour over and get involved with and provide that extra income for people.
Mm-hmm. So you talked about at the longer end. What does that mean in your world?
Yeah, for us, that's, we basically have now, partly because the government's had to issue so many bonds, but, there is a 10-year, 20-year, 30-year bond market here in Australia now, which, 20 years ago we didn't have. And, it's sort of interesting, because when you think about the GFC, we didn't really have that tenor in bonds to provide that true offset. Whereas now, by having that 20-year, 30-year government bond market, you do actually have an asset class that can do a lot more work in times of risk off. And that's certainly what we can get exposed to in this fund and do. In fact, that's where most of our sort of overweight, if you want, for duration is in that 10-year and 20-year part of the curve. Yeah. Because strangely, in our market, we still have a nice positive yield curve. You are actually getting extra yield by heading out that back end, but that will be the bit that really will provide that balance, which is really important for the fund to have.
So a positive yield curve means the longer you hold it, the better yield you're getting. Is that right?
Yeah, I mean, as you move out, you're actually getting paid something for moving out the yield curve, and that's certainly what you're looking for by taking that. But as I said, we're doing it in government bonds, so there's certainly a comfortable factor with that, and I'm sure everyone knows. But despite the fact that we talk about debt levels in Australia being higher, we're still AAA rated by all the rating agencies, and sit in a pretty unique bucket now in the world on that basis. So that certainly helps, and should give people some comfort despite sort of the noise around.
Yeah, can you talk to us a little bit more about that? Why is it that we get that rating compared to others? What are we doing well?
Yeah, well, I mean, despite sort of the noise, Australia does have a very good balance sheet, and, we are managing within our means, certainly at a federal level, and you're seeing that in terms of even having surpluses at the moment, and they're doing the right thing by keeping those and not throwing the money away. And that's very different to what you're seeing elsewhere. I mean, the US has been talked about a lot where, fiscally they're being, I would say irresponsible in this environment. Certainly when you've had, the type of growth they've had over the last couple of years, this should have been where they were putting a bit away, but instead they were, spending it and generating, more votes. So it's a reason why you've seen their credit rating actually decline over that period. So yeah, I think we could give ourselves a little bit more credit that we're being a little more prudent than elsewhere. And it's sort of surprising, I'm sure, for some people to know that, basically like in Italy, is like triple B rated, country. So it's, very different outcomes as a result of their fiscal responsibility over the years.
And so what does that mean in practice? What's the impact of those different ratings on returns or,
Yeah, I mean, well, it's because, as I said before, this fund is there for that defensive element. So you really want to make sure that people feel comfortable during times of risk off, that it's actually got the backing and support that you want to be holding that type of paper during stress. So that's the main driver of, I guess, your outperformance during a risk off event. And yeah, certainly have that, which is great.
Yeah,
and that's why people start to question, well, will the US be the safe haven, going forward? And they will be for a time being, because there's no sort of better spot to go. I mean, everywhere else has their own issues. Japan clearly has growth issues and demographic challenges, and Europe the same. So the growth levels are still going to be pretty strong in the US. So I think they still can hold that mantle for quite a bit longer. But the point is that they, once again, like these other places, they need to be mindful that over time they need to manage their fiscal position sensibly. Otherwise, you do start to slip.
So looking forward, where do you see the opportunities for our market and the portfolio?
Yeah, I mean, once again, sort of coming back to what we have on offer in Australia in terms of investing, obviously got government bonds, semi-government bonds. Look, we're a bit underweight semi-government bonds relative to an index. Well, obviously an active manager. We're a little concerned about the sort of spending that has been going on at a state level. They've been less responsible, I guess, relative to federal. And yes, they have some infrastructure to do, but you need to do it at times when you can afford it. I think there's just been a bit of overwork at that point, and therefore, there's been a lot of debt issuance that is finding it a little more difficult to get a home, and therefore those spreads have been widening, which is exactly what we expected. And so we've been a little bit underweight on a relative basis versus benchmark sort of minus less 5%.
What's an example of a semi-government bond?
Yeah, so New South Wales, Victoria, they all issue bonds to fund their, expenditure, and these are, were AAA rated. In the case of Victoria, they've seen a couple of downgrades over the last few years, and that's once again represents the agency's views on the fact that they haven't been that prudent fiscally, and therefore that means that by having that lower rating, it costs them a bit more money to actually fund themselves, because clearly people are asking for more because your rating is lower.
Yeah.
So it's as simple as that.
Okay. So the semi-government means not federal level.
Yeah, that's right. Yeah, just that next level of government. And then look at our market on the corporate side, as I mentioned before, is solid investment grade. There's a reasonable filter in terms of who gets to issue. The beauty in the Australian market is that we have had, because that is our focus, and there's a reasonable amount of capital in this market. You've seen actually issuers come from overseas to issue into this space. The reason why they do it, they might have a business here. And in many cases, that's the reason. Other times, it's just to find some diversified funding for their business. So they come to our market and issue bonds here in Australia. For us, as a global firm, obviously, we have analysts globally that look at those names, that know management very well because they've dealt with them for a long period of time. And it gives us a real advantage, I guess, in terms of analysing and determining where there is value and getting comfort about where that business is going. So, we obviously lean on our global network to give us that flavour and then for us to determine, how much do we want of it in the portfolio and what is justified. So the good thing about that is that you've had, companies like Apple, AT&T, you've got Fonterra out of New Zealand, and a lot of banks also, global banks that are typically, we would call them national champions because they're large institutions within each of those jurisdictions, come here either to do banking, at a corporate level, or even just to get funding on a global basis. And once again, we find that, those names, because they're probably a little less known to some investors locally, we can lean into our analytical team globally and get insight. Therefore, we like to get involved with a lot of these, what we call kangaroo names, because often they just provide a little bit of extra spread. And as I said, we can get comfort on the credit side. But it does provide, importantly, I think, for investors here is that diversity in terms of what they're getting exposed to. And of course, it's in Aussie dollars, so we're not taking currency risk on that. It's really just pure credit risk that we can get comfort from, as I said, from our analysts. So, what looks like an Australian dollar bond fund does provide you with some good diversity, which is really what you want when you're on the debt side of things. So then that's what our market certainly continues to grow in, which is great. Yeah. I think also when you look at the corporates that issue into that environment here in Australia, like you think about, the Coles or the Woolworths or the Telstra or NBN or any of these local companies, a lot of them are monopolistic, duopolistic in nature. So they pretty much hone their market. So the good thing about that in an environment where we're slowing down clearly is that they will continue to do reasonably well from a debt standpoint, i.e. we know that they'll repay their loans, so that's key. In terms of equity, clearly it's going to be driven somewhat by profitability and, clearly it could be a little bit more challenged. But from a debt angle, all we want to make sure is that we're going to get our money back. And so, these are the types of investments that we're very happy to take in, even in this sort of environment that I'm describing, which is clearly one that is slowing. But yeah, there's good issuance there. There's also really strong issuance in that sort of infrastructure, utility sectors within Australia as well. And I'm talking about airports, ports, transmission lines, tollways. These are often sectors that are regulated by their pricing. So during times of inflation, we've been fortunate because they can just get regulated to push up prices, so they're inflation defensive if you want. But importantly, on the other side is that they're necessity type assets, and so therefore, even in times of slowing, they're still going to do well because they're needed and necessary. I think that the other side to that, which has sort of developed more over the last 10 years, is a lot of these utilities, and you think about the airports and ports. In particular, they're often now owned by super funds, so they're long-term holders. They're not, sort of fly-by-night, structures. They're actually long-term holders, and so therefore, and we saw it during the pandemic, like at Melbourne Airport, they just say, "Hey, look, just get your balance sheet in order. Don't pay us a dividend. Make sure that the balance sheet stays strong, and you ride through these events as well because of that type of ownership, that long-term ownership." So once again, when you break it all down, you can gain a lot of comfort around the types of credit we own in the fund, that they are going to be, defensive in nature, but also importantly, provide a nice income for investors.
So just on the infrastructure side of things, it's an interesting space. Do they typically issue a bond at the corporate level, or are they, project specific, or a variety? Or how
it is typically at the corporate level. So once again, you get great broad exposure to the assets that utility or that infrastructure has. So yeah, you can take great comfort in that. But once again, they're sort of, incredibly difficult assets to replicate. How many airports do we need in a city? How many ports can you actually functionally have? and operationally have. So yeah, they're quite select assets, which once again gives you great comfort that they're going to be there for a long period of time.
Yeah. Okay. So we had flagged that we talk about credit generally. Is there anything to add in that sort of space that you think is worth?
Yeah, I think there's sort of been an opportunity in the last year or so around REITs, because as we know, REITs have been challenged globally, particularly in the US, where they have a slightly different structure with regards to REITs, where they're generally a little more levered, and also the assets can be sort of quite broad based across the country. So in areas where there's probably less activity at times, and therefore the asset price can vary quite significantly. Whereas in Australia, because we're generally based along the coastline, we've got three major centres down the east coast. These assets, particularly if you look at office, which has probably been the one that's most challenged. The occupancy level of these buildings that are typically A-grade prime buildings in the centre of town, everyone wants to sort of be in them. Their occupancy levels have stayed incredibly high, and so once again, incredibly different to what you see in the US or in Europe in particular as well. Where we've actually seen those occupancy levels fall away and the value of the building come down. And so anyway, the reason why I highlight that is that REIT spreads did move wider, on that sort of move globally, and yet it really wasn't justified here in Australia, because not only I highlighted the office rents, but or the office buildings, but think about some of the others, which are like major shopping centres. How do you replicate Bondi or Chadstone in Victoria? You can't. Like it's amongst suburbs and very expensive land, and they're centres of entertainment almost these days. And these are what sort of form a big part of these asset pools. And once again, they're not that highly levered. They typically have sort of A ratings or very high BBB. So they sit well within the asset class. And once again, we saw there was a bit of an opportunity there, and they're the ones that have probably performed very well over the last 6 months or so, because people have finally recognised the fundamental value of those and seen an improvement.
So how do you access those investments?
Yeah, they're just in the market, secondary, and there has been some primary deals, and we've been involved with those as well. So, and they've come with a more generous spread, and happily watch those tighten up. But once again, it's just doing the homework, doing the analysis. But it just means that the portfolio has got, the unlisted fund is, over 500 securities. So you really have got a very diversified, I think it's structured properly to capture that, the defensive element of the bond market, and importantly, perform the way you want to in a risk-off environment. And that's, really key to the setup of the fund.
How do you, it's probably a fundamental, maybe simple question, but how do you kind of trade off that I guess downside protection, risk off, with generating a yield and a return? And how do you approach that?
Yeah, no, it's certainly a good question when you think about, as I said, the way the dynamic has changed. Clearly, the economy is slowing. We think that, credit, short-dated credit is a really great place to be at the moment. But we're mindful of the fact that, the economy is slowing. So we've allowed, that exposure to credit to continue to just move shorter. Right. And that just gives us greater comfort that, we know these companies well enough that they're in a position to repay when the maturity comes due. We've got a lot that are maturing in the next, couple of years. And that means that the portfolio can, really roll into, I guess, higher grade assets if we felt that, things were getting a little ugly. We don't have to go to the market and say, hey, do you want to buy our bonds? We just allow them to mature through, and then us rotate into government or semi-government or wherever we see the best value. And that, is really important. Once again, it's liquidity factor that you need to think about, even within the bond space if you want. But, that's certainly what we've been thinking, and just allowed that. We call it credit spread risk, but we've allowed that to really come down because of the changing environment that we're in.
Mm-hmm. And how do you think about the income yield side of things as a component of the return? And is that something that you're really focused on, or is that part of the overall investment thesis? Or?
Yeah, look, I mean, you just want to make sure that you're getting paid for the risk that you're taking. So that is the key for what we're doing. I mean, the output is going to be dependent somewhat on where the market's at. If you're sort of targeting something, that's when you're probably making bad decisions, because you're really just buying it because the yield is higher. That's not really the best way to attack this. You really to ensure that you're actually looking at, and it's why we call ourselves a fundamental value manager, because that's what we're looking for with regards to our investments. So, and that is really key at the end of the day. And you've got to work to the environment that you're in, and that's probably what we've seen changing the most over the last 12 months or so.
Have you seen any, pressure or change in sentiment from your investors, or, if you've got, I know in this fund it's fairly broad, but looking for more income and sort of increasing the pressure to say we need more income out of the portfolio, or how?
Yeah, I mean, fortunately, we haven't really had that. I think people were generally seeing the opportunity within bond space because of the broader changes that we're seeing. That what we spoke about at the outset, where we had central banks manipulating yields down. Finally, they were sort of, as they had to fight inflation, they had to step back from that manipulation and fight inflation and have allowed bonds to actually move to fair value. So I think people were excited by the idea that you can actually get sort of 5% or 5.5% out of bonds, and that's your defensive component. And you compare it to sort of other asset classes, suddenly it was even attractive from a yield standpoint. So, and of course, the beauty of fixed income, particularly on that fixed rate side, is that by the fact that the idea of yields are possibly going to move lower from here, that's improving the performance and the return for investors. And so, that's the reason why you want to be in bonds, particularly in this type of environment, and particularly because you're starting at a fairer level for bonds, which we hadn't seen for really, as I said, post GFC because of that manipulation. So for me, that's the important component. I didn't think we were going to see it, to be honest, in my career after what we saw during the pandemic, and thought we're going to be Japanese in yield structure. But clearly things change quickly, and that's great for investors. That's all you want.
Yeah. It's certainly the conversation that I've been having with clients is getting that baseline return out of the yield from bonds at that 5% is fantastic and hasn't been available for a long time.
No.
It gives you a nice consistent element to the portfolio which hasn't existed.
That's right.
Which is really comfortable.
And because you've got that duration component, so let's just keep it simple. Like it's 5 years in duration in the portfolio. If it moves down by 0.5%, we have, then that's another 2.5% that you're going to get as a return. So obviously, if it moves down, if things got worse, and we have the whole yield structure moving down percent, then that's sort of like basically 5% extra on top of what you were earning. So that's what you're looking for as an offset. That's the the reason for the people looking at correlation matrices and thinking about how things will work in different environments. But that'll be the offset to your risky assets that could actually be pulling back, which is something that a lot of people haven't seen in their investing life, and therefore don't understand what we're talking about. But there is that risk, and that's becoming more real at the moment.
Yeah, no, that's great. So we had a couple of questions from home, but I think we covered those off in the conversation. But if anyone has any questions, now would be a good time to start typing as we start to wrap up on my list of questions. Is there anything else, Anthony, that you think we should be, touching on, highlighting before we see if there's any other questions from home?
Yeah, good question. I think we've covered a lot actually when I think about it. So there's probably not too much there, but it's certainly interesting environment just in terms of those challenges, I think, and the uncertainty that's now bringing. I think without question, we're seeing this volatility this week. We expect that we'll continue to see it, and it'll be in an environment where, so central banks do start easing more generally, how much will they do? And so markets will be very focused on the data that comes through, and if things are softer, then clearly they just start pricing in more cuts. if we get sort of some sort of recovery, then clearly you can start thinking about rosier days. But you know, we're certainly in a more challenging environment than we were.
And so I know you don't have your crystal ball on you, but, you know, what do you think is the outlook for interest rates here?
Well, I think, you know, the RBA made it pretty clear this week, even though markets started pricing in cuts before the end of the year, that they're not there yet. And you can understand that because, yeah, the June number was an improvement, and we started to see, you know, inflation coming down a little bit, particularly on that services sector, which is where it's been really, really sticky. But they made it pretty clear that, you know, just one number, and it was only just good. It wasn't like it was amazing. That, you know, they're going to need to see more of that to get comfort that we're actually, you know, on the right path and heading back to their target. Because of course they've been criticised that they didn't do enough, which, you know, may shock some people, but they certainly didn't do as much, as I said, as we've seen in the US and certainly in New Zealand. So, you know, by that fact, they need to be really sure that, you know, they're on the right path before they start easing. So unfortunately, that joy is not really coming until, you know, probably second quarter of next year, maybe the first quarter. It really will depend on how that data plays out. But it does mean that sort of relief for, you know, the community in general is still some way off. And you know, that's the component you need to be a little concerned about, because as we know, if unemployment just ticks a little bit higher, then it's less people that actually can afford their current lifestyles. And that's, you know, when the cream starts coming off the cake, unfortunately. And so that's really what the RBA is trying to avoid. But at the same time, they can't jump until they're actually sure that inflation is out of the system.
So you think unemployment is the key indicator we need to?
It is the key indicator. I mean, they're sort of hoping that by 4.5% unemployment, that things will have got to a point where inflation's back under control. But unfortunately, that 4.5, you know, can just sort of skip a little bit higher. And that's, as I said, when you start to lose momentum in the economy, and that's harder to get back just by easing, because people's businesses have gone out of business, and therefore that capital's gone, and you can't sort of just open the door again next week. It's closed, and you know, they're out of work, and so are their workers. So that's the bit that they're trying to avoid, but that is the real risk as we, you know, keep rates higher for longer.
In your work that you're doing, are there any particular sectors that you see as, you know, higher risk, or where you're concerned about?
Yeah, I think it's quite clear, because you're seeing insolvencies starting to spike, and that's something that, in fact, interestingly, the RBA highlighted during the week, and that is a real concern, because, as I said, you know, they're businesses that employ people, that, you know, does destroy capital, and that can, you know, mean that, you know, you really don't have that small business community there when you start up again, because their capital's disappeared. I think that's certainly a real risk, particularly as it's not just the monetary policy side. Like, you know, clearly there's been high costs, insurance, you know, just general goods prices have been on that, with that pressure, and wages really. There's some wage structure changes that have gone on that have actually added more pressure for these businesses. And I think, you know, if you don't have as many people walking through the door and doing the type of spend that they were doing last week, and that's, you know, what the cafes are talking about. People coming in, they used to buy a coffee and a donut or something else, but they're just buying the coffee and walking out. You know, that suddenly changes the relationship very quickly in terms of profitability. And that's sort of what's happening more broadly. So that's sort of what we're sort of focused on at this point. And as I said, unfortunately, we're starting to see those signs appear that are highlighting that, you know, we are losing that sort of momentum that you need in an economy.
Okay. So it looks like we haven't got too many more questions at home. We've obviously done a good job of covering all the important topics.
That's the main thing.
So well done. So, you know, any final words to sum up?
Yeah, I mean, I just think that, you know, obviously we've seen some, you know, solid performance out of bonds lately. I think that, you need to stay the course at this point. I think there are, as I said, and I don't want to be the doomsday person because that's certainly not the way I am. But there is certainly some question marks over the direction here. And as I said, we've got these sort of structural headwinds that aren't easily fixed, which does mean that the RBA will be forced to be a little slow in terms of easing. And so that's the real risk here. And that, therefore, it's the reason why we have a little bit more duration on this point in time is that, we do think there are some risks on the downside. And therefore, staying the course is really key here. You're still getting great yield. So it's like cheap insurance, really, in many ways within the portfolio. And so that's really the key point.
Great. I think that sums up very much our thinking when, we added you guys to the portfolio, increased the duration, that underlying yield, which we talked about before.
Yeah.
So, thank you for the work you and your team have been doing and looking after our clients' money.
Yep.
And thank you very much for your insights today. Hopefully that was really helpful for everybody at home.
Yeah, thank you. Thanks for the time.
If you have any questions, please get in touch with myself or with your advisor. And for now, we'll sign off and have a good day.
Great. Thank you, everyone. Thanks, Jeff.